Right on.
All right, here we go. Anytime you're ready, go for it.
Hey everyone, this is Jessie Hartnett from Honor Your Heart, and you are listening to the Vroom Vroom Veer with. Sorry, I got to start over.
It's okay.
I want to say the podcast, but
It's all
I'll say
good.
Vroom Vroom Veer.
That's why I
Okay.
say if you screw up, that's okay.
Okay.
Yeah, no, it's
Let's do
okay.
it.
It's easy.
Take two.
Take two. Here we go.
Hey everyone, this is Jessie Hartnett from. Hi everyone, this is Jessie Hartnett, founder of Honor Your Heart and podcast host of You Can Quit Smoking. And you're listening to Vroom Vroom Veer with Jeff Smith, reminding you that you can quit smoking.
Perfect. You're like, oh,
you can quit smoking.
What do I say now? The lovely ...
Yeah.
It's all good. That's perfect. Thank you very much. Let me hit stop. I'll be right back.
Okay.
Are you ready to thoughtfully steer away from your revved up, frenzied, and far too often scripted life? Then welcome to Vroom Vroom Veer with Jeff Smith, where he guides you down the road differently traveled by sharing unique experiences with guests who have managed to shift away from a life stuck on cruise control and veered their way into a more authentic and fulfilling one in all sorts of interesting and kind of remarkable ways. Get ready to Vroom Vroom Veer with your differently traveled road chauffeur, Jeff Smith.
Bernard, thank you so much for being on Vroom Vroom Veer and welcome to the show. How's it going?
Good. Thanks for having me.
Yeah. So you are author of Index of America, and you got a fancy website. So talk a little bit about what you're most excited about in your life and the book and what's going on with Tom Bernard today.
Oh, thanks.
Yeah, no problem.
Just released the book in March.
Okay.
So that's really exciting. But also I'm going on my 24th wedding anniversary later on this month, and then my youngest is going off to college.
Wow.
So we got a lot going on.
Yeah, that's a whole
Exciting.
lot of stuff going on.
Yeah. So it's all good.
24 years. Good for you.
Yeah. So that's been really positive, and the book is going well.
Excellent.
Excited to be able to talk a little bit about it, and the reason why I kind of got into writing the book is really because of my kids and my interest in personal finance, and really wanted to be able to explain as clearly as possible kind of some of my thoughts and reasoning behind why the S&P 500 is such a great investment for everyone, from people just starting out to people that have been investing for a long time.
Sure.
And so I came into personal finance kind of the traditional route. Is I had some money troubles when I went into college. Like many people, my parents got divorced, and that significantly changed my financial outlook. And so I had to get smart about money, how to earn money, how to save money, how to invest money, all that kind of stuff. And so I went through many years of just trying and failing and figuring it out. So I've done of just about every wrong move you can make, whether it's investing in high risk speculative funds, thinking you're a genius, doubling, tripling your money, then losing it all very quickly and realizing nope, you were just lucky,
right?
Trying to go through, okay, how can I save? How can I budget? What to do? How can I increase my earning power? Just all those types of things, and really realized that the simplicity of investing in the S&P 500 and the consistency that enabled me to have, in the sense that I didn't really need, once I put the money in, I didn't need to think about it. I spent some time dabbling in real estate and rental properties, and had some tenant issues, and realized that there's a whole lot of headache that can happen there.
A lot of work.
So tried to figure out, it's a lot of work. Just figure out what can I do on a consistent basis that allows me to live my life and focus on other aspects of it, whether it's family or career, etc. So the S&P 500 is kind of where I settled on, a couple decades ago, and it's been, personally for me, it's been a great investment, as well as for many others.
Yeah.
And you hear about it all the time. It's in the news. It's you hear it referenced, but really, a lot of people don't know that much about it. So the S&P 500, it's the Standard & Poor's 500, and it's been around since 1957. But even before that, there were two separate companies, Standard Statistics and Poor's Publishing, that have been around since the late 1800s, early 1900s, and they've been tracking funds in a very consistent way since the early 1900s.
Right.
And that consistency over many, many years and understanding, the trials and tribulations of constructing an index and how it evolves over time has really made Standard & Poor's the kind of the premier benchmark for
Right.
for capitalization weighted indexes. And what's interesting right now, I mean, we're recording this here in mid-June, and SpaceX is going public today.
Crazy.
Right?
Crazy.
It's crazy.
But they're held out for a year. I found out, like, they're not going to be in the S&P for a year, but that's okay. I'm kind of happy about that.
Yeah, and so the S&P 500 has some requirements. One
Right.
of them is, in order to be eligible, one of them is capitalization, the minimum threshold. Right now, it's about $22.7 billion value for a company, which SpaceX is well over that. Right. But the other one is that it has to be public for at least 12 months.
Right.
And then there's a third one, a quality filter, where it has to have 12 months of profitability. So it can lose money for the last 3 quarters. And then if the fourth quarter is a blowout, and if you add them all together, it's net positive, you're eligible to be added. But there is a human in the loop for the S&P 500 in the form of the index committee. It's not just a purely rules-based index like others, whether it's the total stock market or Russell 1000, whereas as long as you meet these certain requirements on this date, you're automatically in.
Right.
The index committee has to let you in, and they want to strike a balance in terms of being reflective and representative of the overall market balance across sectors. So the global industry classification system has 11 different sectors. They want to make sure that they are owning the largest and the best, most representative companies in each of those sectors.
Sure.
And so as a result, over time, it has just continued to perform in a very positive fashion. And that's why today it's one of the largest indexes and the premier US benchmark.
Yeah. That when I found out, I've got a long story. So let's take a break from finance for now, because it could get finance heavy, and let's just have some fun for a while. But yes, I want to nerd out about the S&P and how I found out about it being like when I started. I'm going to go back in time now, but I'm going to take a bit of a detour. My dad gave me some advice that turned out not to be great, but my uncle gave me some advice. He said, open your IRA, and this is pre-Roth IRA, right? And max out your IRA. And if you don't know what to buy, let me know and I'll tell you. And I was like, okay. So he told me to get this Janus fund. And I was like, whatever. Okay, Uncle Lorne, right?
Yeah.
So I bought it, and I was, happy as a clam, and I had no idea what I was doing, But eventually, right, as I was watching the performance, not all that often, but I would be like comparing it to this other line. And I was like, what's this other line that's doing better than my thing? That was the S&P 500, right?
Yeah.
So I was like, can I just buy that other thing? Yeah. Turns out you can, but it took a while to figure that out. Anyway, I digress. So where did you grow up? What part of the country are you from?
Born and raised in California.
Oh, nice.
So been here my whole life. The Central Valley, a little town called Fresno.
Okay, sure. Everybody knows Fresno.
Yeah, agricultural, rural area.
Right. You're taking all the water out of Lake Mead. Give some back.
Yeah. No, I think that's Los Angeles, but
it could be. I think it's apparently, from what I heard, it's agriculture is taking the biggest suck out of the straw anyway, but that's not important right now. Okay. So Fresno, I like it. So what were you like in high school? Were you like a super nerdy guy or like an athletic guy or?
Oh yeah, no. So high school, very, very outdoorsy. I swam, I played water polo. I had a job as a lifeguard. I taught swimming lessons. I'm still very active swimmer. I live in San Francisco now. Swim out in the bay on a regular basis.
Gotcha. So you were like Spicoli.
More like Spicoli, yes. I wasn't the greatest student, but was having a really good time.
Excellent.
Yeah.
Says everything I need to know.
Yeah.
Surfer dude. All right.
Well, I like, we won't go too far into it, but I like to say college was the best 6 years of my life.
I just rewatched Animal House not long ago. 15 years down the drain. Anyway. Okay. So I guess you went to college and you studied finance, I guess, right?
I studied environmental economics, which is the economics associated with like land and water
Oh,
and
interesting.
fisheries. It's
Oh,
all
yeah.
the stuff, right? And so coming from Fresno, as you mentioned, water is a really big deal.
Sure. Oh, yeah.
And
Huge.
so, not to get too far into it, but California, big state, right?
Right.
2/3 of the water falls in the northern half, but 2/3 is consumed in the southern half. So there's this
Right.
big project where there's this aqueduct that kind of shuttles it all from north to south,
Oh, I
and
didn't
that's
know
a
that.
big deal. And so,
Yeah.
so studied it. It's called the California Water Project.
Right.
So study that. But then getting a job in water is really hard. So I ultimately ended up getting a job in real estate. There's a lot more
Sure.
jobs in real estate than there is in water economics.
That
So-
makes sense. Okay.
So,
So how did you end up in the finance world? Is that like an after
so
thing?
yeah, no, great question. So I graduated from college in the late '90s and had gone to Cal. So I was in the Bay Area, but my first job was down in Los Angeles, and they were just businesses in the Bay Area were hemorrhaging young people to startups. And so I got a call from a big consulting firm at the time, Arthur Anderson, that needed people, and I'd applied for an internship in college, and they were going through, like, they were digging deep into the well, right? Like they were calling college interns that they
got all the way down to
rejected,
Spicoli.
Yeah, I mean, literally, like I applied for an internship and got rejected, and then they called me like 2 years later. That's how deep they were going.
Because they had your resume on file. Okay,
yeah,
gotcha. Okay.
Exactly. So they had my email and phone number and all that stuff.
Wow.
And I said, great, love to come back to San Francisco, and got a job during the dot-com boom. And
nice.
In their valuation group. So it was valuing startups and real property and equipment, just anything that they needed a value on for financing purposes or tax purposes. It was a great experience, had a great time, and rode that ship pretty much all the way until it sank.
Till the bust.
There was the dot-com boom, then there was the dot-com bust.
Right.
I was able to hang out for that. But then ultimately Arthur Anderson, where I was working, went out of business because of the Enron scandal.
Right.
So I was there until I closed the lights off in the San Francisco office.
Wow.
Yeah.
Wow. So was that like a big deal? I mean, did you have a plan to get out of that, or?
Yeah, I mean, it was a big deal, but it was all very orderly, and the good news is
you could see it coming, I suppose.
Yeah, and it was very well organized in the sense that there were other consulting firms that bought different parts. And
nice.
ultimately, I mean, I just
kind
took
of a
all
soft
my files
landing, sounds like. Yeah.
Yeah, walked down the street, put some different initials on the letterhead, and off I went. Right?
I went through something similar when I retired from the Air Force. I hung up my uniform in the back office and then had these new clothes on. But I was in the same facility.
Yeah.
Same people, different office. Yes.
Yeah, doing the same job, just with a different name. On it,
right? I had a different job, a much easier job. I would say like only a job that you could get in the military. One of those kind of jobs. Anyway.
No.
So anyway, okay. So when did let's talk about like things that you talk about in the book. And then, like I said, like when was this epiphany about the S&P 500 being the thing for you? Yeah.
Yeah.
When was that aha moment?
Yeah, no, absolutely. So big fan of John or Jack Bogle and Vanguard,
Yep.
and he was the creator of the first.
Yes,
exactly. was the creator of the first S&P 500 index fund back in the 70s.
Okay,
so I'd read a lot of his books and was very, very interested in that and the whole efficient markets and all that kind of stuff. And so I had been investing in a total world fund for many years, and different periods of time. International does better or worse than the United States, but over time, realized that there's diversification. Do I really need to own 13,000 different companies when I was seeing the S&P 500 that only had 500 and it was doing a little bit better, right? And it represented such a large portion of it. So if we look at like the end of 2025, the total public market was about $107 trillion. The U.S. was about $66 trillion, right? And the S&P 500 was 60 of it. So more than half of the total kind of investable public market was the S&P 500. And realized that, you know what, that's good enough for me. And at some point, I'd seen Warren Buffett say, I think it was like in 2013, hey, I'm telling my wife 90% in the S&P 500 and 10% in short-term treasuries. And there was
Right.
part of me that thought, if it's good enough for him and his wife, like,
Totally.
I'm good with that. I don't need to think too much more. I'm gonna go that way.
I'm
And
with
it's
you.
been really good.
Yeah.
So
Well, I went through what a lot of investors talk about, like core and explore, right? I had that thing where it's like, okay, most of my money, like almost all of it, let's say 90%. I don't know if it was exactly that, but most of it. And then I just peeled off like enough to play with, just to have something to do. Right.
yeah.
Right.
So that's totally understandable, and I recommend, I really appreciate curiosity and interest and people wanting to kind of
Right.
tweak, right? Try to,
As long as you can,
whatever
you're
it
not,
is,
it's not going to kill you if you lose that money.
Yeah.
No big deal.
Yeah, but
Right.
but at this point, and for the last decade or so, I very much want to set it and forget it. Like, I don't
Yes,
want to think.
I'm
about
with
it,
you on that
right
now. Yes.
So I've stopped tweaking. I'm just like, listen, I'm happy checking it once a month, once a quarter. Like, I just want to know that it's
Right.
good. Yes, it goes up, it goes down, but I don't want
Right.
it to be on my mind every day.
Yeah.
Whereas I found that when I was tweaking stuff, I was very very curious and would always be looking and checking, and I just didn't like that.
Have you ever played with options at all? I know I'm getting into the weeds, but did you ever play
I
with
personally
options?
have not. I strongly considered it. I bought some books,
Yeah.
and realized, you know what? I know enough that I've read a couple books, and I know that it's probably way more complicated than
Yes.
that I understand,
Right.
and so I'm going to just stay away, right? But I thought long and hard about it.
Yeah.
And then the one that I did go into was the leveraged funds, where you can get 2x or 3x or whatever.
Totally.
And I was like,
Yeah.
I'll do the two. I did, I think,
Right.
the 3x S&P 500 fund, and realized that basically I just really had no clue how it worked, and I'd owned it for several months. And it's not designed to be owned for several months. It's a trading tool that's designed to be owned for a day or two. And the whole volatility decay and the part that kind of just really blew my mind was S&P 500 was up a good chunk, and my expectation when I invested was, if the S&P 500 is up 10%, I should be up 30% because it's 3 times. And then when
Turns out that's not
when
how it
it
works.
wasn't, right? No, when it wasn't, I was like, wow, I guess I really don't know how this works. Right? And the good news is I was willing to kind of cut my losses and be like, okay, I'm going to back away, and I'm just going to do the S&P 500. And so now I just stick to straight VOO, which is the Vanguard ETF.
Yeah.
And that's been great for me.
So don't do what I did if you're listening to this show, but I did play. So Motley Fool had a newsletter that included options, right? So, and I told myself I wanted to understand it, and I did put in the effort like you did, but I'm going to go ahead and be honest with you. I never really understood it, but
but you went ahead anyway, right? Yeah.
It turned out more or less okay.
Okay.
Yeah, it turned out more or less okay. Like I would say my chief complaint was how I found out about the California little present that they give you every tax year of 7% on capital gains. I was like, hey,
yeah,
I need to move. hence
taxes get you, right?
Yes.
Taxes get you.
But I mean, that's actually a good thing. And that meant that I had a gain.
You were making money.
I had gains to complain about. Right. But yeah, the thing was the way the Fool newsletters work is they send out like buys and then get outs.
Okay.
And as long as you could figure out how to do the buy and the get out transaction wise, which I screwed up because they're complicated.
Yeah.
And depending on the platform you're on, if you make a mistake, you're like, oh shit, what did I do? Right. And then you don't even know how to get out of it. So that's kind of why I quit. Especially the more like exotic setups. Like there was a couple of setups that I didn't really know what was happening, but I could see how it worked transaction wise. Like you buy this thing that lasts forever, and then you can leverage that and do this other transaction that makes a little money over time until that long thing stops being a good thing. See how I'm not explaining it? That's why I should not have ever done that. Anyway.
Well, the good news is you figured it out and you got out of it.
Yes.
Right? Without too much damage.
Actually made scary amount of money. I mean, really, like you make a lot of money. I know now why people do it. But, you have to be like ready to get a text and do that trade like immediately. Mm-hmm. That's why that was the thing that I was like, well, I can't do this now. I'm at work.
Yeah.
And so I have to I don't know, go figure out how not to screw it up at lunch or something. Anyway. Yeah.
Yeah.
That. Don't do options unless you really know what you're doing.
And I think that's a really good point. So there are people that are very interested in it, have the time and the willingness to do the trades, to get the information and take those actions, right? But there are other people that don't have that ability during the course of their day because of their job or their other commitments or whatever, and so they're not going to play that game, and they're going to be more long-term buy and hold investors that just know that over time it's going to go up. I mean, it goes up and goes down, but over time their money will grow, without them having to worry too much about it.
Right. Totally. Yes. Now personally, I'm all out of individual, no more individual stocks. I'm like 100% robo, basically.
Okay.
Not 100% robo, but close. I had a bunch of these Vanguard mutual funds, and like none of the robos will do mutual funds, right?
They're now all ETFs.
Right. So what I ended up doing was moving them all from Schwab to Vanguard, and then I could convert them for free to the ETF version of the fund, and let them sit there long enough so Vanguard didn't hate me, and then I moved them to the robo. Right. So whatever, it's I'm just trying to make the machine more automatic, as they say.
Listen, automatic investing and dollar cost averaging is a great way to go. I use the Vanguard platform, and I've got a day job, and every paycheck a little bit goes into VOO, and life's good.
Nice.
Yeah.
There you go. So now that you could probably say this better, but I think Warren Buffett said you have to learn about compound interest because you're either going to earn it or you're going to pay it. So yeah. So talk a little bit about how you tell people about why they should be getting into investing. Even more important than that, get out of debt.
Sure. So I guess as we take a step back and look at just personal finance, right? There's the very first thing you need is income. You need to have you need to be able to figure out how to earn money.
Yes.
And earn as much as you can given your skill set and abilities. I think the S&P 500 is a great investment. Don't get me wrong. But generally, investing in yourself in the form of education or skills or whatever is going to be your highest ROI, because it will allow you to increase your income. Once you've got a good sustainable income, skill set, then there's the other side of that's your expenses, and figuring out how to control your expenses so you have a gap between your income and your expenses that you can actually invest, right? And to the extent that you had to make some investments in education, and maybe you had more expenses than you did income, and you've accrued some debt, right? The thing that I advocate is knocking the debt out, like you're on fire, right? Kind of more the Dave Ramsey approach, just focus everything on knocking out the debt.
Right.
And when I came out of school, I had student debt, and it took me several years to knock that out. But once I did, just getting to zero felt so good.
That is huge. Just what you said right there is huge. Right. Like most people, if they want to think about money, first they don't want to, right? Yeah. They don't want to think about how much they're spending, and they don't want to think about retirement. But really what you want to do is imagine what it would be like if you only had a mortgage, right? Or not even a mortgage, just no debt at all. And you paid off all of your credit on a monthly basis. How would that make you feel?
Yeah.
That would be great, right? I think
absolutely. So once you have your gap, you've got your kind of your investable the amount of money that you can invest, or some amount of money that you can invest, right? It's almost like, you've got some seeds now that you can plant, right? And they say, the best time to plant a tree was 20 years ago. The next best time is today.
Right.
And you just need to plant it, and you need to wait. And what'll happen is, over time, that the money that you invest today will grow. And so but you continue to do it. You invest, periodically, every 2 weeks, whenever you get paid, every month, whatever it is. But each of those seeds will ultimately grow, but it takes a long, long time. So just one fun fact about the S&P 500 is, last year, about 85% of all of the earnings from those 500 companies were returned to shareholders in the form of either dividends or share buybacks. Right. And a share buyback is really, you don't see that money, but it helps to increase the value of that share. So imagine, in the form of a share buyback, that seed is getting a little bit bigger, or that it's growing a little bit. And that happens each and every quarter, each and every year. And so you plant the seed, and maybe after a year or two, you've got this little sapling, but after 10 or 20 years, you have a pretty big tree, and it's got some branches, and now all of a sudden it's actually giving you some benefit, right?
Yeah, totally.
And now you keep doing that, and what'll happen is that was, you get that tree from the investment that you made, today, but you're doing that every 2 weeks. After 10 or 20 years, you have an awful lot of trees, and they're all ultimately kind of producing fruit, and it just continues to grow ever more, more and more.
Totally.
So the deal with the compound interest is that as long as you don't spend it, or, theoretically, like, cut down the trees, you're good. They're going to keep growing. Right?
Yeah. Yeah. It's like, I can't remember who, but one of my favorite bloggers said, like, what if somebody told you when you were 16 that you could make a machine out of money that made more money?
Yeah.
Because that's what investing is. It's a machine that makes more money.
Yeah, absolutely. And if you start young enough and allow it to go. So the compounding, the easy math is, your dollar will roughly quadruple about every 15 years. So, like, the rule of 72, right?
Yeah.
But it'll roughly quadruple every 15 years. So you invest $1 today, 15 years, you're going to have 15 more years, right? 16, right? And then all of a sudden you realize, wow, okay, that gets pretty big pretty fast.
Right. Yeah.
Right.
Yeah. And let's talk a little bit. This is something I just only learned, and I've been doing this for a long time, but like taxation on capital gains, especially now, since, I don't know, they changed the rules a little I don't know when, but not too long ago. You have like a lot of leeway on capital gains, and what do they call them? Qualified dividends. And they get treated differently. I mean, it's completely different than W-2 style income.
Yeah, from a taxation standpoint, earned income, qualified dividends, and capital gains are all viewed differently from the current tax regime.
Yeah,
absolutely. And the thing is, dividends, you are not in control of when that you experience that. The company is going to issue that dividend. Right. And so generally they issue it every quarter. But capital gains, that is triggered when you sell a stock. And so to the extent that you don't sell it, you are basically rolling that money and deferring any taxation until ultimately when you do so.
Right.
So that's one of the benefits of a buyback, in the sense that you're not getting taxed on that capital that's being returned to you until you choose to sell.
Sure. And most of your life, you're going to be letting it roll. I'm only just in my very, very first year of spending.
Well, congratulations. That's a great spot to be.
It's a little scary. But when I did the math, and so like I'm on that financial independence retire early thing.
Oh, nice.
So like the drawdown rule was, about 4%. That's, cash in.
Bill banging. Yeah.
Yeah. And then 4% should, not destroy the machine is the idea, right? You're taking off just enough to live off of, and the machine will just keep spitting out more money. Right.
And what's interesting about that is that he's recently updated that study, and he wrote a new book. He wrote a new book, and he adjusted it to actually closer to 5% now. I think he said like 4.8% is kind of the sustainable rate. And one of his comments was that 4% was always meant to be like the floor, right?
Oh, okay.
That wasn't the target. That was like, if you do this and you've got this certain mix, I think it was 75-25, but in terms of asset allocation, you're good. And what he's found is as he's redone it is that there's a high probability that you will effectively die with much
way more money than you need.
Yeah, way more than money that you you started with. Right.
Right. The other thing is though,
increased it a little bit.
The thing that I'm learning a little bit is like, when you look at like Betterment and Wealthfront, it looks like you're going to die with this big pile of money. Right. But if you drill down into that a little bit, like your expenses don't stay the same, right? Because of inflation. So you are spending a little bit more every year, right? So your expenses are going to grow. So I don't know if those little graphs and charts mean like I'm actually going to have that money. We'll see.
Well, and that's the thing, right? Who knows? Whose crystal ball is more accurate? Nobody knows, right?
Yeah.
But what's interesting is, so I was listening to something today. Morgan Housel has a podcast, really like him as an author, and he was talking about like the reaction function to the Strait of Hormuz closing, and the whole like, oh, it's been closed now for a few months. We thought oil prices were going to spike way up, but people have adapted, and there's been things that weren't necessarily anticipated.
Right.
If you were to experience a market downturn, the question is, how would you react? Would you just keep spending the same amount of money? Probably not, right? Like you'd probably pull in the reins a little bit, not go on as many vacations, or decide that you can drive your car a little bit longer.
Yeah.
Right?
I think people do. Like I noticed like in the beginning, like we've got an electric car and a hybrid. So we were trying our best to just keep that full tank of gas
Yeah.
until the end. It turned out at some point I was like, well, we got to drive places, don't we? The Leaf only goes around town. I wanted to go to LA. So I guess that plan isn't going to last more than a month.
You're in a stunning place. I'm assuming you have solar?
Yes.
Yeah. Okay.
It's awesome.
Yeah, that's great.
I recommend it. I keep looking at batteries, right? So like I have the battery solution already done. And
for your house?
Yeah.
The battery storage? Yeah.
But it's not like the full on. I just bought like the $1,000 like battery pack that can keep my fridge going.
Okay.
And I can charge it like from the Leaf, or I can charge it like at a friend's house, right?
Okay.
So that's the cheap version of, if the power grid goes out in Vegas for a couple days, my stuff in the fridge is not going to melt, right? We can go to a hotel. Hopefully.
It's good. Yeah.
Maybe. I mean, if it were the whole grid, then we would be in trouble, right? But still, I just looked at it again. The whole home battery system is still $20K. That's a lot. That's a lot for something you probably won't ever need.
Yeah.
I mean, if it were that the Vegas grid was going down on a regular basis, then I might consider it. But it hasn't. I mean, if anything, the grid here is more spiky than it's surgy. Not like brownouts, right? It's more like too much power on occasion.
Oh, interesting.
Right.
Yeah, be curious to see if that continues. You hear about all the stuff with data centers and energy demands, and going out 5 or 10 years.
I just saw a little snippet about like our American grid is in trouble again, and that's why I went and repriced out the solar battery system. Yep, still too expensive. Anyway, all right. Well, let's talk a little bit more about how people can get in touch with Tom Bernard. And anything else you want to talk about as we wrap up here?
Sure. So I've got a website, theindexofamerica.com.
Right.
Has ways to get in touch with me. I'm also on Instagram at Index of America, and starting to do a little bit on YouTube at Index of America as well.
Right.
So those are the best ways to get in touch with me. And then I think the key is the whole point of writing the book was to give people that are not everyday traders or very active in the market, but that are, like my kids, my wife who's a teacher, just give them comfort and understanding in that how the S&P 500 works, and that it's something that they can rely on over time, not 1 month or 6 months, but years, decades, etc. Right. And so there's some case studies in there about one of them is about the Nevada Public Employees Retirement System and how they have chosen the S&P 500 as their sole source of U.S. equity investment.
perfect.
Right. And it's this multi-billion-dollar pension fund, and they are performing in the top 3% of large pension funds. So it's the sort of thing where it doesn't matter how much money you have, the S&P 500 is a great
kind
investment.
of a no-brainer.
And,
Right.
And just the key thing is to just stay the course, stay invested, ignore the noise, and you'll do okay.
Yeah, and don't check.
If you can help it, don't check.
Don't do options. Really, don't do options.
Don't do triple levered funds, right? Yeah.
Anything that looks like an investment, but you don't understand it, then that's gambling.
Yeah.
It's not really investing. Like easy things, yes, do it. Hey, Tom, this has been a blast. I appreciate you hanging out with me for about an hour.
Yeah. No, thanks, Jeff. I appreciate it. It's good talking to you.
All right.
Thanks for taking the time to ride along with us on another episode of Vroom Vroom Veer. For podcast info and show notes, be sure to head over to vvveer.com. That's VVER.com. Man, that's fun to say. And we'll catch up with you next time here on Vroom Vroom Veer.